Hi, Harry here with the Rant on October 20th, Friday. It continues to look, and I'm really hoping that this bounce off of late 2022, after finally we got the first crash of a bubble that went another couple years later than it should have happened. We really should have seen that crash from late 2019 into late 2022 time frame. So it all got pushed about 2 years by all this never-ending stimulus. So that's the world we're in. But of course now the Fed so overstimulated in reaction to COVID. Now they have over-tightened 525 basis points, and they're probably going to go a little more before it's all over. And that's all going to weigh. We keep talking about in the newsletter that it's all going to weigh on lags, and everybody's aware of these lags, but nobody's really figuring it out. Basically, the lag from the past stimulus wears off about now, and the lag from the tightening should hit about now. So the next year and a half should be all negative from that point of view. So again, I'm still thinking July 19th was the bounce high after that first crash in 2022. And now we're heading down, and we're in the first wave down and a bounce off of that. So what I'm really looking for here, if we can break NASDAQ 13,000, just below where we are, it says the momentum still looks down, and we're likely in this next wave down of a larger crash that's going to last well into 2024, if not all the way, after peaking in late 2021. Okay, so that's what we're looking at. We need to know, are we heading into this crash, or do the markets still believe, and the fact that this bounce was so strong and so high, higher than the bounce off the 2002 tech crash, higher than the bounce and longer than the bounce off the 1929 first crash. So investors have not gotten washed out of the bubble logic yet. It's going to take this next wave down. And of course, the full confirmation of that is breaking that first low on the wave down, 10,088 on the NASDAQ. But again, we got to break 13,000 just ahead to look like we're still heading down, and that we're likely to continue to do so. Now, something else that, you can always watch, and one of the things I watch is it's bullish, bearish sentiment indicators, I call them. But what really the markets come down to, there's the smart money, and if you think that's a good thing, for you, it's not, okay? If you're one of those people that think, no matter every time I buy in, I always seem to buy in right near the top of a move, and when I finally sell, it always seems to be right near the bottom. That's because the smart money is your enemy. It's a small percentage of large, highly leveraged traders, and they're the ones that more steer the markets, okay? And how do they do that? They watch everybody else. They watch you. They watch us. And they tend to do the opposite. When everybody's poured into a nice bull rally, they will start shorting it and then knocking it down. And the more they do that. And then the same thing. When everybody's panicking at the bottom and they can see there's a capitulation and most people are selling, they're going to buy there. So you have to start thinking like the smart money. You can't ever quite be them. They have better information than you. They've been doing this longer. That's all they do for a living. And the other thing that I remind people of, with this stimulus that artificially pushes short and long rates, but in this case, short rates especially, down to zero or near zero levels, that just emboldens this smart money, because they are leveraged typically, and they can borrow more at less cost, and that just gives them more power to kick our asses, okay? So the smart money is your enemy, okay? And so one of the things we can watch, it's hard to measure the smart money per se. You can see when for no reason the market turns around and starts to go up. Well, that's them invisible. But we can measure the everyday investor. And there's a number of sentiment indicators. Two of the ones I most follow. One is the investor's intelligence, okay? They have sentiment indicators that measure smart versus dumb money. And they just break it down in those two categories. So when it gets up towards 60% or a little higher, that means investors are too bullish, and that's a sell signal. And when it gets down to that level of bearishness, then it's a buy signal, okay? So we hit the highest levels here recently at 61% bullish, 18% bearish. So that's a sign here, and recently that yes, you should be selling or getting out of the markets. The other one is the American Association of Individual Investors, AAII. They have their bull-bear percentages and ratios, and since they have a kind of a neutral in the middle, it doesn't take as high to get overbought and oversold. So when it starts to get towards 50% or a little more bullish, that's a sell signal. And we just saw that right at the top in July 19th, 51.4% bullish percentage. And the last bearish signal was 52.3% bears, about as low as it gets, in December 21st, 22nd. And we basically bottomed between October and December in various indices after that first crash, okay? So these sentiment indicators are also telling you it's a good time to be out. And of course, my longer term indicators and chart patterns say major top. I mean long term. In fact, we may not ever see a top that high in the US and major indices, okay? Even with the millennial boom to follow, because we will not be in a bubble era by then, and the millennials only bring us back up demographically to where we peaked with the baby boom, okay? So that's the outlook for now. This is a time to be out if you aren't. We've had a big bounce, okay? So last chance here recently to get out, and including now, because we've started to head down and we're bouncing off of that first wave down. So this is getting last chance for people to thinking, well, maybe it's gonna make new high. Maybe I should stay in a little longer. My advice is don't look a gift horse in the mouth, okay? And a break of 10,088 is going to say we are well into this middle wave, or what's called a third wave down, and we would still have a fifth wave likely to follow that. And again, at this point, I'm not looking for a bottom in stocks until at least the summer of 2024, and at the latest, late 2024, okay? And you gotta know, real estate, if stocks peaked in late 2021, it looks to me that real estate started to peak in late 2022 into now. It's kind of like just turning, and real estate last time went down for 6 years before it fully bottomed, although most of that damage happened in the first couple of years, as will be this case. So again, last warning, folks, this is the time to get conservative. We should know soon, probably late this year. A weak January would be another really bearish indicator, because as January goes, the year goes. And if we get a weak January, which I think with this next wave down, we're very likely to get, that'll just be more reasons to say, be out of the market, stay out for a good while. And remember, on the other side, it's the buy opportunity, the investment opportunity of a lifetime, the last great one we will get before the millennial boom, which will probably kick in for stocks between 2025 and 37. And of course, it keeps reverberating around the world into Asia as I cover more and more. So that's an update here. Keep listening. More coming.